Yes, I've been looking at the banks from last week, mostly their earnings. So I looked at the kind of four banks that I usually have a look at here: JPM, Bank of America, Citigroup, Wells Fargo, the kind of big money centre banks, I guess, as they're known, rather than the sort of investment banks of Goldman Sachs and Morgan Stanley. Though I've got a little bit on those two as well. I'll save you a kind of boring run through the numbers, but the kind of take-home point is that basically everyone beat on everything. Revenues and earnings per share were higher than expected from pretty much everywhere. In general, revenues were up across the board, ranging between sort of 10% up and 6% up. And earnings per share were basically down more or less across the board, ranging between sort of 17% to 25 or so. A few little bits of kind of differentiation between them, I guess, but here's some general themes that are kind of going on that won't surprise sort of anybody. I was mostly unsurprised by all this stuff that I saw, not the precise numbers, but the kind of general themes coming out. So investment banking fees, are down more or less everywhere. Wells Fargo doesn't really have an investment banking arm, but we'll come back to those in a sec. And net interest income goes up by quite significant amounts, double digits in all of these cases. So, in other words, the money that they make by doing stuff like underwriting IPOs or sorting out SPACs and that kind of thing, especially Citigroup, which was quite big on SPACs, most of that has disappeared. That you could probably have told just by keeping a vague eye on the market. It's a lot quieter now for IPOs and SPACs than it was before. And the kind of money they make by taking in deposits, paying interest on them and lending it out in the form of loans and mortgages and credit cards and what have you at a higher rate. Most of that is higher than it was before. And pretty much across the board, what you also saw, the reason that revenues go up and earnings go down in these cases, so margins shrink quite a bit, is big increases in reserve losses. So things for covering bad debt, basically. This time last year, they were pretty much all releasing stuff they'd had built up to get through sort of a COVID-ish kind of spell. Now they're all busy building reserves back up again in order to comply with Federal Reserve stress test stuff. So earnings were lower, but not as much as expected. Revenues were higher and higher than expected. And one interesting thing that I saw here is that headcounts were higher than expected. It's only Wells Fargo that shrunk its headcount. If you like following the banks, as I kind of do, you might have seen that this is where a lot of my students go, actually, for what it's worth. A lot of them go off to be kind of Morgan Stanley, Goldman Sachs bankers and so on. There's been a lot of I guess I want to say complaining or discussion, perhaps, about the conditions of junior bankers and the number of hours they have to work and so on and so forth. That kind of got circulated around on Goldman a bit. And Goldman responded by saying they were basically going to right-size their numbers and get rid of most of them. They don't appear to have done that. Headcounts are up pretty much everywhere apart from Wells Fargo. Wells Fargo, they, perhaps unsurprisingly, have lower mortgage demand with higher interest rates. That's basically what's been going on. What catches your attention there? You guys own some banks, right?
Yes, the thing that sort of jumped out most for me was just a comparison really between the quarters. I noticed a lot of news outlets were reporting that, year on year, JP Morgan's interest income their income was down about 14% or something along those lines. But you've got to think about the sort of quarters we're comparing really, in that the reserve loan losses were being released, now they're being built up. So realistically, when you sub all that back out, it's nowhere near as dramatic as 12, 13, 14%. It's just, it's just a difference in the way they're reporting income. One is, it's almost like reserved income that you can release at a later date, and now they're going back to reserving income. So, but I was interested in JP Diamond's CEO, as JP Morgan, Jamie Dimon's comments. He was cheerleading the Fed to a certain degree, and I guess he kind of has to. He's not in control of any of their policies. He can't do anything that affects that kind of policy. So all he can do is wish them well, and I kind of guess that's what he was doing. I've noticed that they booked about $1 billion loss on treasuries. Treasuries have not been in a great spot. They wanted to reposition that. They had mortgage bonds as well, which always fills you full of fear, doesn't it? After the big short. And the other thing I noticed that really caught my eye was Goldman Sachs were talking. One of the things that they've done recently is build up a retail banking arm. They've got the Marcus brand. It's over here in the UK. It's quite competitive, really, in the savings accounts, but from what I understand, they're looking to sort of scale the expansion of that back. They're not going to spend too much time focusing on that anymore. Outside of that, Citibank was probably the weakest of the three, I would say. And we would expect that because, as we've said a few times before, Citibank has a lot more consumer debt than the others, or at least in terms of concentration. It's a lot more concentrated on that kind of debt, and that kind of debt is just, it's not struggling at the moment, but it is on the more struggling side, I guess is how I would describe it. Did anything jump out at you, Paul? Have you even seen them?
It's the you've covered a lot there, particularly Jamie Dimon. I didn't see it as he was wishing well on the Fed. I saw it as very slightly different, as in it's very beneficial for JP Morgan to have interest rates go up, so I can see why he would follow that one as much as he could. But also I think he is very fearful of inflation and inflation in the economy, and I think he's a bit traditional in that sense of the word, and sees that interest rates are pretty important as well. So rather than sort of cheerleading because he can't do nothing about it, I think he seemed to genuinely think that the Fed is doing the right thing, and that obviously makes JP Morgan very rich in the same bet. Investment banking or investment returns from retail was quite telling. I think that's very important to see that investing still isn't particularly popular yet, or it's not as popular as it was in 2020. So companies like Goldman are not seeing as much money from there. And finally, mortgages. Mortgages, I think, is the big tell there. I think we are not seeing as much house buying going on as we should, particularly in the second-hand market. New build market, though, is doing very well, and rental seems to be doing very, very well as well. If you look at some of the renters, one of my favourites, Avalon Bay, and one of my other renters, well, I say it's a renter, Lennar Corp is a new build house builder primarily, but it is actually branching out into the rental market, and that says it has seen very, very strong uptake in its I think they call it single family homes that they are renting out at the moment. So that's very interesting to see how that dynamic in the US is going, and I think that's going to be exactly the same thing that's happening in the UK. And I actually see some of the big house builders here in the UK doing running a similar model. I don't think they're going to go into mortgages like places like Lennar and DR Horton do, but I do think maybe setting up houses, the affordable housing that they have to put in each new build plot. I can see them, rather than handing them off to a housing association, I can see them maybe benefiting more from renting out now. So there's no plans that have actually been announced for that just yet, but I can see that model works over in America, and maybe it might be something for the UK house builders to pick up. However, banks going forward looked very, very strong. It sucks for me that I'm not 100% in the market right now, because it means earnings season is going to be very, very positive, and there's going to be a bit of a jink. Michael Burry said there was going to be an earnings collapse. That so far is not happening, right?
So far, no. I mean, earnings are quite significantly down at the banks in all of these things. If you kind of compare them year over year, what they're not is as far down as people were perhaps expecting. In the case of Citi Group that Steve mentioned, another reason it didn't do quite so well, and this is a kind of deep structural issue for Citi Group, is that the thing that's really been pushing earnings along for the banks is rising rates in the US, and Citi has more of its business exposed outside of the US, basically, in emerging markets and so on. So somewhere like Bank of America, which has a fairly heavy concentration, gets a big push off those kind of rising US interest rates. That's going to have a disproportionate effect on Bank of America compared to Citi, which is one of the reasons for Citi underperforming. It's a reason a lot of people don't like Citi very much, to be honest. It's kind of exposed elsewhere. I agree with that objection to it for what it's worth. I own this stock. I just think it's far too underpriced compared to offset that thought. But all three of us have been thinking about housing, I guess, a little bit recently in our own sort of different ways. Paul in terms of thinking about his Help to Buy mortgage, me in terms of looking for somewhere to buy, and Steve with a fascination of basically conducting armchair surveys on the things I'm trying to buy based on his Rightmove stuff. But I kind of think these rising interest rates, I know in my head rising interest rates are good for banks because margins expand, basically. The amount you loan out at expands faster than the amount that you take in deposits at. So it's good, your margins get bigger. It feels to me like that's the case until it isn't, though, as in until interest rates get so high that your mortgages all start going bad. And you don't have to think people wrote mortgages terribly to think that they wrote them at a rate where if the interest rate quadrupled or something, so it went from 2% to 8% or something like that, which doesn't strike me as beyond the realms of possible at the moment. It wouldn't be such a good thing for banks. Eventually, they would have to start dealing with the thought that their mortgage debts aren't good anymore, no matter how carefully they kind of wrote them.
It's unlikely to be a problem for the US banks, isn't it? Because mortgages in the US tend to run a lot longer than they do over here, so they tend to have a mortgage for the life of the time it would take to pay off, and it tends to be fixed for that period as well. So
yeah, why is
we're only talking about
why do we have to run off like five years, but the US do 30-year terms. We have a mortgage. Sorry, just need to explain this to people because I think this isn't common knowledge that. Here in the UK, we will have a 25-year mortgage that when you buy your house, but you fix your terms, or you have the choice to fix your terms, usually over a 2 or a 5-year time. And very recently, 10-year has been coming in. But over in America, you can fix your term for the full 30 years. I don't know what rates they are. Last I remember they were something like 4%, so they weren't stupidly low, but that's a good old price to pay for the entirety of your mortgage, and it gives you a bit of security that something's going to happen. And that's why we think that the US housing market might not collapse in the same way that the British one will. Apologies, I just wanted to interject there and just explain that out.
Well, the reason why they're so long is probably because of 2008. So in 2008, a lot of the mortgages went bad, and that was part of the reason people couldn't pay them back and everything went bust. But the reason they're so long this time is probably because two reasons: that the rates have been very, very low. When you have a 30-year mortgage, you can charge quite a higher rate because you can speculate that the mortgage rates might go to 3 or 4%. So if you can charge out a 30-year mortgage at 4%, that's still going to be quite appealing to people. The banks still get a decent rate back out of it. The consumer gets a fair deal. And also the consumer gets the security of knowing that their payments are going to be the same from now until they pay it off, which, when you think about it, we'd probably take that, wouldn't we? Especially knowing what 100%. We know today.
100%.
So, but the reason it's shorter in Britain is just simply because it's not offered as a product. And we do get up to 10-year fixes now. I have seen a few of them knocking about, but the rates tend to look unattractive until you get to 6% mortgages that we have today, and all of a sudden they look a hell of a lot better than they did. But that's the general rule. The other thing I was just going to flash back to was Lennar. One of the problems with the Lennar renting out is that they take the cost of building that house onto their balance sheet. And which is fine for a company like Lennar and for companies like DR Horton, which have tons and tons and tons of cash. But that's not necessarily what companies in the UK tend to have.
Very
because
good
we
point.
divvy out so much of the cash that they generate. They tend to. I mean, Persimmon divvied out like 20% dividend yield last year. Which was pretty much all of its cash and a special divvy as well.
It's a 97%
so they don't hold as much cash
payout
on there.
ratio on Persimmon. Sorry.
Exactly. So what happens at that point is that when they're planning on divvying out all their cash at such a record rate like that doesn't leave an awful lot for you to be able to absorb some costs of building a house and shoving it on your balance sheet and renting it. So I don't think we'll see that over here, and I don't think we'll see too much of it over in America. The way I see it is a bit like when Upstart started taking loans on their balance sheet, and it's simply because they couldn't sell the loans on. And I think that's kind of what Lennar are doing. They're thinking, hey, look, if this is a short-term thing, we can keep building, because there's nothing worse than sending all your joiners and all your brickies home and then go and get them getting jobs everywhere else, and then all of a sudden the building trade picks up again and you've got to try and rehire a whole squad of builders and joiners to, well, there's no such thing as a builder in America, they're all joiners. and they don't do anything with bricks. But yeah, so but there's nothing. There would be nothing worse than having to reassemble a team. So I guess what Lennar are thinking is, look, if this is a short-term thing, a year or whatever, we can start banging houses onto our balance sheet. We can keep the team in place. We can keep building. We can keep going through the materials that we already have, and that makes a lot of sense to me. But it won't make a lot of sense if this thing lasts 3, 4, 5 years. All of a sudden, you might see Lennar ground to a halt and start to run out of cash.
Very, very good point, actually. The return on a home that you build to rent comes over the lifetime of the home rather than traditionally when you build a home, you sell it off and you get the money back straight away. So, yeah, you're right. It's if you're going to look at it in that way, you're going to have to look at it as a long-term prospect, or at least hold all that on your balance sheet. And eventually, I don't know, you could get a greater return on investment, but it just take a long time, right? You get that cash flow coming in from the rentals, and then eventually you sell it on to whoever wants to buy it, or maybe even the tenant themselves. But yeah, very, very interesting. And like you say, I think you need a good, strong balance sheet on that one. And yeah, some of the bigger companies in America have that.